Let's get you the latest on tech. AI investment very much in focus. Lisa joins us now from the Greenwich Economic Forum with a special guest. Good morning, Lisa.
Good morning, John. Yeah, here it is not a government shutdown. It's a beautiful morning in front of a beautiful waterfront, and I'm here with Kipp deVeer, who's the co-president of Ares Management, which oversees almost $600 billion. And Kipp, thank you so much for being with us.
It's great to be here.
I do want to start where John was talking about this idea of the tech build-out and how much private asset managers have been instrumental in that. I'm just wondering how much you are continuing to accelerate your investments into digital infrastructure, given that everyone is worried about an AI bubble. Are we investing too much? Are we seeing the fruitions of our money?
Sure. So we've sort of transitioned that business to be broader in its scope. Historically, we've been largely a lender to the space, so a senior lender and a mezzanine investor as well through our debt infrastructure business. We did a recent acquisition that you may be aware of a business focused on industrial logistics investing, mostly in Japan, but it's global, and they have real digital infrastructure development capability. So we've started to roll that out. We've done 2 completed projects now in Tokyo. We have a 3rd underway just on the outskirts of London. So we're getting more active on the development front. I think that the measured approach that we've taken getting into the market doesn't, frankly, put our investors at risk, right? Our goal is to generate great returns for our investors. So we think if you stay in tricky markets, i.e. hard to find entitled land, and then you're building really high quality facilities, which we think we are because we have an in-house team that came with the acquisition. It's pretty easy for us to find great leases from investment grade tenants like the hyperscalers.
Are you passing up opportunities that concern you? Do you see things out there that do worry you?
I think we're selective, and I think if you look historically, in areas like this over the last 20 or 30 years, typically when this much capacity comes online, some of it at the end of the day is going to have to be marginal, right? These trends tend to lead to overbuilds in certain places, so I think us being selective and being measured in what we build is super, super important.
One thing that we've seen over the past 5 years is an incredible consolidation of market capitalization of the biggest asset managers, the biggest private asset managers. I'm thinking of the ones that you won't name, like Apollo and KKR, and of course Ares. I'm just wondering whether you think this is the sort of path to follow, that you think the biggest are going to only get bigger and dominate the space.
Look, I mean, we've believed since the beginning, frankly, of the company that the more scaled platform, both in terms of diversity of asset classes, but also diversity of geographies, was a huge advantage, right? So we think we get better information, we participate in more markets, we probably do better due diligence because we have better access points. So I think the both investing advantages, but also the capital raising advantages are real, and you see that with the growth of Ares, with the growth of Apollo, and the growth of all the Blackstone, KKR, all these folks that have consolidated share for sure.
You just actually did see another record year for fundraising, and it feels like it's accelerating with respect to how easily it is to really get interest from investors. What's sort of been the tipping point? Where are you seeing that interest really coming from?
Yeah, I mean, we grew up raising most of the capital from the firm from institutions. So it was pensions, sovereign wealth funds, et cetera, and we've really diversified the way that we raise capital today. So I would say an increased focus on the wealth channel, for sure, an increased focus on what our insurance clients are looking for, because they're very challenged in a tight spread, lower rate environment. So it's just become more and more diverse, and I think as we're able to educate and offer access to investors that didn't have access to certain products before, there's just a lot of uptake from a new set of clients that are interested in what we can deliver at Ares.
How much is that going to be turbocharged by some of what's coming out of Washington, D.C. to open up some of the private asset management field to 401k accounts?
Look, I mean, I think our view is that it's probably a ways off for that to really provide a lot of lift, but we are incredibly supportive, obviously, of bringing our products into channels where there's interest. And I do think that those groups of investors today who have not had access to alternatives deserve access to alternatives.
So right now, one thing that is another theme for the year has been American exceptionalism and this question of, is it still the best place to invest? And I wonder, as the co-president of Ares, whether you see the greatest opportunity in the United States or whether you increasingly are expanding overseas, that you see better investment opportunity there.
Well, I mean, so I think holistically, we've been looking to expand geographically for a host of different reasons, just to give our investors more access points in terms of geographic diversification and asset class diversification. But to actually answer your question, I do think, despite some of the instability that people may feel here, that most of the investors that we see around the world are most excited still about investing in America.
It's one thing that we've seen sort of this idea that everything was going to fall apart in the first half, and suddenly we're talking about a reacceleration, and suddenly the M&A that everyone had been expecting is coming back online. We're actually seeing those deals come to place. How active has it gotten for you? I mean, how much are you seeing this in your business?
So, I mean, look, the first 3 to 4 months of the year were pretty rocky, particularly up through April, and that really slowed transaction volume everywhere. But I'd say in most of the asset classes that we're in, everything has rallied back to where it was pre-Liberation Day and even through that. So credit spreads are incredibly tight, whether you look at high-grade corporates or high yield or loans. The equity markets are obviously up through highs. The thing that we're most excited about is actually kind of a shift for folks that see maybe some of those markets as expensive into some of our real assets businesses. So the recovery in real estate, which we think is real, is offering a lot of opportunity for us to kind of play into the sectors that we like. We refer to kind of as the new economy real estate. So that's industrial, that's logistics, it's self-storage, it's multifamily. And we're seeing, we talked about it for a moment earlier, a lot of investment in the infrastructure space, whether it's traditional or digital.
How much is that predicated on the idea of Fed rate cuts, or how much is that completely independent and a sort of secular bet on some sort of shift in the economy?
I don't think it's particularly, reliant on rate cuts. I think rate cuts help equity more than it helps credit and lending businesses. So our own view is the yield curve is probably over-predicting cuts. I frankly think the economy here is pretty good. And policy, while it's a bit restrictive, doesn't seem to be slowing too much down here in the States. So transaction activity is picking up, and valuations, as I mentioned, have recovered in almost every asset class. So I do think we'll see a slow decrease here in rates to try to provide some relief and keep the economic growth that's slowed growing. But my own view is I don't think rates are going to go down as quickly as maybe you're reading about in the newspaper.
So I have a feeling I know how you're going to answer, but what concerns you more? Some sort of downturn in the next 6 months or some sort of reacceleration in inflation?
The latter. The latter. I mean, I think we see the economy is good, although the growth has slowed. And that's partially as a result of rate increases, by design to obviously try to deal with inflation. But I think that the real scary moment is that if you see a reignite of inflation and the Fed has to really dramatically rethink their policy, which I think has been one to leave rates where they are / reduce them a bit, which is obviously going to accommodate more growth and more rise in valuation.
Kipp deVeer, thank you so much for being with us. This is really fun. Let's do it again.
Appreciate it.
This is Kipp deVeer, of co-president of Ares Management.